You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
If you look back traditionally, 25, 30 to 1 has been the old extreme buy signal for get out of gold and buy oil. And 10 to 1 has been the extreme buy signal to get out of oil and buy gold. All of those records were shattered in this last cycle. And so now you've gone from that massive high last spring on the relationship back down to sort of 29, 28, which seems like we've worked off the overvaluation, but we really haven't. We're sort of, even on historical precedents, we're still extremely undervalued in oil and overvalued on gold. So we think that there could be some further rallying room.
Thanks for tuning into Mining Stock Education. And joining me again is Adam Rosenswag of Gehring and Rosenswag Resources Mutual Fund. Adam's a returning guest. We had him on the show about 6 months ago, and his main call in that interview was spot on, in which he said oil will outperform gold over the next 6 months. So it's been 6 months later. Bring him back onto the show. Adam, thanks for joining me. That call was right on. Do you have any updated thoughts on that call that you made on my show and how you positioned your fund 6 months ago?
Well, great to be back. Thank you, Bill. Yes, going back 6 months, that is basically exactly what's happened. And just to give your viewers a little bit of color and backstory, the way we arrived at that decision last fall was something that we've been studying for a long time at our firm, and that's the relationship between gold and oil. And when we looked at, it sort of sounds simple, but when we looked at over time, the price relationship between 1 ounce of gold and how many barrels of oil that can buy, what we noticed was a long trend and a long pattern, periods of intense gold overvaluation, oil undervaluation, and then vice versa. And using those metrics, it's been very predictive to be able to determine which ought to outperform going forward. And so when we found ourselves in 2020, because of COVID and various related demand issues around oil, combined with all of the monetary and fiscal stimuluses that were being put in place to respond to the pandemic, we started to see an unprecedented relationship between 1 ounce of gold and 1 barrel of oil. Now, obviously, when oil prices went negative last April, remember they went to negative $40 a barrel, the relationship or the ratio between them became sort of meaningless. However, if you look at it from month end and what have you, you were talking about 90 to 100 times. One ounce could buy 90 to 100 barrels of oil. We've never seen anything like that before, going back really since oil was first commercially discovered in Pennsylvania and Azerbaijan 150 years ago. And to us, that was very emblematic of future outperformance of oil to normalize that relationship a little bit. So when we came on the podcast last time, gold was about 1950, oil was 40. And here we are 6 months later, gold has sold off about 15, 16%. It's down about $200. About 10% rather, $200 to about 1770 today. And oil at the same time has gone from 40 to 60, so it's up 50%. So what does that mean? Where do we stand today? You've worked off some of the overvaluation of gold. When we came on the podcast, I believe the ratio was 50 to 1. Today it's down below 30 to 1. So, on some measures, things are moving in the right direction. The relationship between oil and gold is normalizing. But are we at the point yet where we want to be cycling out of oil investments and into gold investments? And there we think not quite yet. And there's a few reasons for that. First of all, a relationship of 30 to 1, or where 1 ounce can buy 30 barrels, that's still really high historically. If you look back traditionally, 25, 30 to 1 has been the old extreme buy signal for get out of gold and buy oil. And 10 to 1 has been the extreme buy signal to get out of oil and buy gold. All of those records were shattered in this last cycle. And so now you've gone from that massive high last spring on the relationship back down to sort of 29, 28, which seems like we've worked off the overvaluation, but we really haven't. We're sort of, even on historical precedents, we're still extremely undervalued in oil and overvalued on gold. So we think that there could be some further rallying room. Second, when I look at the near-term fundamentals between gold and oil, we still prefer to favor oil investments and oil fundamentals. And the reason for that is last year, we really saw a huge supply response across the global oil industry in response to much impaired demand because of COVID. So, COVID meant that people stopped moving around, particularly air travel really fell precipitously. That had an impact on demand. And people around the world started both shutting in wells and then laying down rigs to not drill new wells. As we all know, oil wells deplete. And so you have to constantly be drilling new ones. And we're not anywhere near drilling enough to hold production flat. So we continue to see here more than a year on, we continue to see production falling quite precipitously. We just got some numbers out of North Dakota where the Bakken Shale is located. And they saw a huge decrease month on month for the month of February. So we're still seeing those sequential declines. Remember, the shales have been the only source of supply growth for the last decade. And so if those are impaired now, we're going to start to see some really significant tightening in oil markets. And we're seeing that. Inventories are falling around the world. So as demand recovers, the oil story, I think, continues to have legs and continues to look very bullish. And indeed, I think, prices are responding and the market is starting to, I think, perceive that a little bit more. So what about the gold market? Well, in the gold market, since we last spoke, a few things have happened that I think are, at least in the short term, a little bit problematic. And the two things that I'd like to highlight, the first is you're starting to see liquidation from what we call Western investment demand for gold. And how do we measure that? Well, we look at the ETFs. To us, Eastern buying is typically more physical. Western investment is typically done through the ETFs. That's a broad generalization, of course, but does tend to hold true. We saw, for instance, for most of the last decade, as gold prices fell from 1900 in 2011, 2012, and started to fall down, more price-sensitive Eastern physical buying took over, and that sort of absorbed a lot of the liquidation coming out of the ETFs. Now we're seeing that happen again. In the last year or 18 months or so, we saw big accumulation from the ETFs. Western buyers stepped in. And in our estimation, Western buyers are a lot less price sensitive. What do I mean by that? Well, when gold starts to move up, the Western investor says, I want to own some precious metals, and they jump in. And they're less sensitive to what the price is. They want that position. Eastern physical buying, there's a long history and precedent in many cultures in the East to own gold, but it's a very price sensitive type of buying. When you feel as though there's a little bit of weakness in the price and there's sort of a good opportunity, a lot of physical buyers will step in countries like China and India and look to take advantage of that low price. But as soon as prices rise again, you'll see that buying disappear, and you can actually track various price premiums and stuff like that to try to get a sense of that. So what we're seeing now is we're seeing the Western investor liquidate a lot of what they accumulated over the last 18 months. And remember, that's pretty price agnostic. That's true when they're accumulating and when they're selling. So that's a little bit troubling. The next thing that we see that's a little bit troubling is the role of central banks. And recall, starting in really 1999, central banks went from being net sellers of gold to net buyers of gold. And that was a huge change that helped tighten the gold market a lot and helped put in the bottom in the late 90s and led to the rally through the 2000s. And in the last 8 or 9 months, we've started to see central banks first slow their gold purchases and then turn from gold net buyers to actually net sellers. So that obviously raises some concerns. And I think that the reason for that is fairly straightforward. I think that COVID has really made it difficult for many governments around the world to meet their fiscal responsibilities. And so they find, less sort of, all attention has to be paid on various monetary and fiscal stimulus to help address domestic issues. And there's less sort of money to go into accumulating gold reserves. I think that's true also when you look at the countries that are doing it. Turkey and Russia have turned into sizable net sellers. And again, I think that can be explained by looking at some of their fiscal situations domestically. So whatever the case may be, short-term or long-term, it's happening now immediately. And I think that's a new source of supply that we haven't seen before. So when we look at the oil supply demand picture, we're quite constructive. And when we look at the gold supply demand picture, at least in the near term, we see some challenges. When you layer on the relative valuation, it still is in the favor of oil and away from gold. And so we think that this period will probably continue for a little while longer. Now, over the long term, we remain bullish on gold. And for those investors who are not looking to allocate between oil and gold like we are, I think that gold is a very good long-term investment, particularly for people that sort of want to buy gold, put it away, and not worry about it for some time. And the reason I say that is that the global monetary situation just keeps getting more and more extreme. So if you look at how much money has been printed in the last 12 months, it puts the global financial crisis to shame. This is the first time we're coming out of a recession or a COVID-led recession with the banking and financial system fully intact. We never had a banking panic. We never had a financial collapse. That's very, very rare for a recovery. Normally you have an impaired banking system. So there's all these sort of situations where you have all these indications where you have ample liquidity in the system, huge amounts of money have been printed, a working financial system, and now we're entering into a recovery. And so I think that backdrop over the medium and longer term actually bodes quite well for gold. And so for those people that are longer term focused or people that are not looking to make a decision between oil and gold, I think the gold represents a pretty good long-term story. But in the short term, there's still some challenges.
So you look at the oil and gold ratio as your primary indicator for when you're going to move money out of oil into gold. And if I recall in our last interview, it was 25% would be the full weighting within your fund for a gold position when that's fully allocated. Do you have a price per barrel of oil, or is it only that you would look at, say, I think we're peaking out here, or is it only this oil to gold ratio?
No, we certainly have a price target on crude, and the only thing that I would point out there is there's a little bit of a difference between what we would sort of call our mid-cycle equilibrium price, which is a price target, and where we expect oil prices could go. And just as a simple, example of that, our mid-cycle oil price is not $25 a barrel, and yet oil very easily got to $25 a barrel. So very clearly the price can overshoot and undershoot. And I think people intuitively understand that it can undershoot, but they seem more skeptical of ever admitting that perhaps it can overshoot as well. So our long-term mid-cycle price is probably somewhere in the $85 a barrel range, and maybe 85 to 95, let's say. I do think if you took oil back to 100, there are certain parts of the shale basins that might not be economic that would then all of a sudden come in the money. So would it be possible to grow supply again from the shales, at least for a year or two or three, with $100 oil? You probably could. I don't see why you wouldn't be able to based on our studies of those basins. However, if there's a perception of shortage, which I think there's a strong risk that we could get into here, because I think, we've gone through 10 years where the prevailing wisdom in the oil market is that we have plenty, that we're sort of running into oil, that, we're opening up new shale basins for development, and that's leading to sort of big step changes in terms of production. If we start to have a new investor psychology where instead of surplus, we have ongoing deficits and shortages, I think that oil prices can very easily go above what I would call their long-term sustainable price. And so I think that you could easily have oil over $100. Last time, in the last cycle, we took oil up to $145 a barrel. That was in 2008. And you definitely saw some demand destruction taking place at that high price level. I would say that certainly would be a top here. And I would say probably lower than that this time for a whole bunch of different reasons, including I think that the global economic landscape is probably a little bit shakier today than it was in 2007. Or sort of pre the crash, pre the run up and crash. And I think that the challenge or the competition from various sorts of renewables would this time probably, if you took oil to 145, because of shortages around the world, I think you could make a much stronger case for some of the renewable energies.
Arcana Silver is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven and probable silver reserves grading nearly 37 ounces per ton silver, with all-in sustaining production costs of only $8 per ounce of silver. The mine is fully funded and permitted with infrastructure already in place, and has announced production will commence in 2021. Achieving successful production should result in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com.
Would you say that the green energy movement might be a little hyped up right now? How do you perceive any bubble that might be occurring here?
We certainly do, and we've been quite vocal and adamant saying that we do have a green energy bubble taking place today, and I think it's really unfortunate for several reasons. The most important is that if you actually do believe that we have a carbon problem, which I think most people do, and you believe that that ought to be addressed and solved, the issue is that we're making massive malinvestment into technologies that I don't ultimately think will achieve that goal. And the problem there is that if we do have a wipeout, like I believe is coming, and we can talk about some of the reasons why, that's likely going to shut off funding for some other very viable technologies and other viable strategies that could help reduce carbon going forward. And I think a great example of that is look at what France has been able to do with their carbon emissions. They have by far the lowest carbon emissions per capita or per unit of energy consumed anywhere in the world. And it's because they have a huge nuclear power base. If we could sort of address these issues sensibly and address some of the weaknesses and limitations of wind and solar and electric vehicles, I think then all of a sudden people might give things like nuclear energy and nuclear power a more thorough investigation and a little bit more of a sensible analysis. Whereas now, that's just not happening. And what's happening is the price action is begetting the narrative and the story, and you have this feedback loop. So for instance, what I mean by that is if you look at the clean ETFs that have gone up 5, 6, 700% over the last, pick the number of years, that are based predominantly on electric vehicles, wind and solar, I think it makes it very much more difficult to be able to say, look, I think there's some real challenges with those technologies. People say, how can that be? The stocks keep going up and up and up. That must be some type of a validation. But the problem is that those problems are there. Those limitations of wind and solar, namely the fact that they're intermittent, are there. And so if we just had sort of an honest discussion, I think that we would have a much more sensible policy going forward. And the risk here is that so much money now is poured into these technologies and so much money is poured into these stocks that you are approaching bubble territory, or you've long gone past it. And I think the results could be quite detrimental. And that in turn is going to make it very, very difficult to actually fund realistic solutions going forward. And I'll give you a great example of that. If you, just the other day, and we've been saying this for now 2 or 3 years, electric vehicles are very efficient once they've been produced. So once they're on the road and they're charging from the grid, they are more energy efficient and they're more carbon efficient than an internal combustion engine. But there's a big caveat there. It requires a huge amount of energy to produce an electric vehicle, and notably to produce the battery that goes into the electric vehicle. So much energy gets consumed making that battery that by the time you roll the two vehicles off the lot, the EV is at a huge deficit, both in terms of the amount of energy that it's consumed and in terms of the amount of carbon that it's emitted because of all that energy it consumed. And it's not until some level of usage that it begins to approach parity. So the Wall Street, and we said this back in 2017, the Wall Street Journal just recently wrote something that corroborates a lot of what we talked about. And they say that, it's somewhere between 100 to 200,000 miles where the electric vehicle will become more CO2 efficient, energy efficient, what have you, total net basis relative to the internal combustion engine. So that raises a few problems. First of all, how long do you expect the battery to last? Because in this analysis, it sort of assumes that the battery lasts the full 200,000 miles. But if your battery is lasting between 100 and 200,000 miles, then you're going to have to replace the battery right where you sort of break even. And remember, that's where all the energy is fixated, is in manufacturing of that battery. Second, let's say you do get to 200,000 miles. You're talking about eventually, I think a savings against the internal combustion engine of like 20 to 30%. So if you look at transportation and the CO2 generated from transportation, and you assume that every car on the road can be turned over to a Tesla, which in and of itself is, astronomical, and obviously is going to take decades to do, and we'll run into problems with running out of battery metals and all types of things like that. Then when it's all said and done, of the transportation slice of total CO2, you can probably shave 20 to 30% off if everything goes properly. I mean, that's just astronomical. You're talking about, since transportation is like 20% of CO2 and you're going to shave maybe 20% off that, you're talking about reducing global CO2 by 4%. You look at cement, for instance, cement's 10% of global CO2. Steel is 10% of global CO2. I think 8 or 9%, but round it to 10%. And those are not attracting any investor interest or any investor capital. And so the biggest problem that I see is that if in fact this bubble in clean technology and clean energy that we have going on today does burst, what it's going to do inadvertently is close the gate on funding for a lot of these other technologies that actually could, in a more efficient and a more sensible manner, address much bigger portions of that CO2 pie. And that's going to be a real shame.
And uranium, as you mentioned, is part of the solution, like we see in France. When we spoke last, if I recall, about 15% of your portfolio was in uranium. The equities in uranium have done well the last 6 months. Have you increased that allotment in your portfolio? How have you been playing the uranium equities recently?
Yeah, we've added a little bit, and then prices has helped to lift that as a weight. I think we're approaching or at around 20%, so not a huge change. We added, I think, one name. The problem with uranium investments is that there's not a lot of producing companies out there, and there's not even a lot of really, frankly, good next generation companies on the horizon. So you have to sort of pick your spots a little bit carefully.
Was that a play on words when you said there's not a lot of next gen?
Yeah. That is the new name that we've added, and then that's been disclosed. So the way we model things, that's probably the best, or the way we see it is the best of the new generation of uranium mines. And so we had said, going back a couple of years, we'd identified that as a name we likely would add at some point once we felt the uranium bull market had legs. And some people could probably say we waited too long, and others could say we maybe jumped in too soon. So we'll have to wait and see. It's a bit of art and a bit of science, but they do have a high quality mine compared to other names that are out there. But their feasibility study is based on a higher uranium price than what we see today, and that's sort of the true across the uranium mining space. All the junior guys need a much higher price in order to move forward. That's one of the reasons that we're bullish on the space. And so, I think we're up, just shy of 20% of the portfolio. I think that certainly when you look from a technical perspective, if you want to be really serious about reducing CO2, in our mind, what you need a technology that's a more efficient converter of energy from fuel to usable power. And you need something that's base loadable, and you need something that doesn't emit carbon. And there's really the only thing that meets those criteria is uranium. Gas is very efficient. It converts energy 30 to 1. It does emit carbon, about half the carbon of coal. So in some regards, it's a very, very good path to go down to try to reduce CO2 as well. It's base loadable, but there's carbon involved. Renewables is not base loadable. It is not more efficient. In fact, the efficiencies are terrible when you look at how much energy is required to make a windmill and a solar panel versus what it can dispatch. You're not talking 30 or 40 to 1. You're talking like between 5 to 1 and 10 to 1. So you're talking about 70% degradation in energy efficiency there compared to gas. And when you look at uranium, you're talking about 100 to 1 conversion. So by far the most efficient harnessing of energy that we've ever known as a society. Completely base loadable and carbon free, at the point of emissions. The carbon that you generate is in constructing the facility and stuff like that. So very, very de minimis carbon footprint. So we definitely think it's part of the solution going forward. We also think, quite frankly, that the near-term rollout of new capacity through China and India alone makes up for a very bullish supply-demand story. So, people say, okay, are you guys really invested in uranium here for the long term because you think that we're going to have a huge push in the West? I do think we're going to, and I think that's going to be a massive, massive, massive tailwind to the uranium story. But even without that, it's quite a bullish story because of what's happening in other parts of the world. But the Western world doesn't seem to get it right now.
Do you think the hydrogen fuel cells have a place to play in everything we've been discussing?
No, not at all. I think the big problem with the hydrogen fuel cell is that if you look at, so what is hydrogen hydrogen, some people think of it as a fuel and some people think of it as a battery. And really it has some characteristics of both. I tend to think of it a little bit more as a battery. And the reason I say that is hydrogen doesn't exist in nature. So you have to manufacture it. And the way you manufacture it is you put electricity into the system, you create hydrogen, which can then be transported and stored. And then you run hydrogen through a fuel cell in order to create electricity. So to me, the hydrogen in that equation is very much the same as a battery, if you will. Now, the problem is lithium ion batteries are very expensive, both in terms of energy and in terms of capital to manufacture, but they're actually quite efficient once they're manufactured at taking power in and then discharging power again, 90%, call it, depth of discharge and things of that nature, round trip efficiencies. When it comes to hydrogen, there's no upfront energy cost, but what you do is you lose a huge amount of the electricity that you put into the system. So first, what you have to do is you take water and you run it through an electrolyzer, you put in electricity and you try to break the bonds between the hydrogen and the oxygen. And you're trying to separate that water into oxygen gas. And what you're really going after is the hydrogen. That's incredibly energy intensive. And you lose, when you look at the energy contained, the potential energy contained in the hydrogen that comes out of that electrolyzer, you've lost 30% of the energy that you put in right there. It's consumed making the hydrogen. Then you lose about another 15% when you then compress or liquefy the hydrogen and turn it from a gas into a liquid and transport it. And then you lose another 30% when you run it through the fuel cell again. So when it's all said and done, you've lost about 70% of the total energy that's gone in, which is quite onerous. How do you overcome that? Most people that are pushing for green hydrogen today will say, okay, well, what we're going to do is we're going to take all of that malinvestment in the wind and solar industries, all the redundancies, all the times where the wind's not blowing, the sun's not shining and stuff like that. And we'll use that. So it doesn't matter. We could lose 95% of the energy and we'll still be making out ahead because we would have lost all that energy anyway. So I suppose that's true, but that's not the stuff that total global energy supply chains are built on, sort of taking up a little bit of the redundancies and things like that. You're not going to be able to displace parts of the fleet even, let alone be able to justify costs of conversion for fleets into fuel cells and things of that nature. If you're effectively just taking the waste power coming off of wind and solar. The other issue, of course, is that we don't think that there ought to be a huge amount of waste energy coming off of wind and solar because to begin with, those are not very efficient sources of carbon-free power. So the whole thing becomes a little bit circular. But what it comes down to is the fact that if you're going to lose 70% of the power in a system, it's going to be very difficult to be competitive with anything else, both in terms of energy efficiencies, clearly, but even in terms of carbon. The carbon source needs to be 90% less carbon intensive than what you're replacing in order to be able to make up for all that lost energy. And nothing that we see today, certainly not wind and solar, can do that. So ultimately, you'd be better off burning gasoline in an extremely efficient gasoline engine than trying to build wind and solar and create green hydrogen, lose 70% of the power through that. And the other thing I should point out is that electrolyzing water and running it through a fuel cell, we've been doing that a long time. And so I think there's a bit of this feeling that perhaps we have a big technological breakthrough coming around the corner. We see very little indication of that. It's a fairly straightforward equation to be able to look at what the limits are to that efficiency. And there's just inherent thermodynamic limits to how efficient you can make that. And we're basically pretty much there now.
Adam, one more question before you go. Any soft commodities you're bullish on that you might be able to share with us?
Yeah, we're bullish throughout the grain complex, and we play that through investments in fertilizers mostly.
And the phosphates have done well, right? Recently.
They have potash phosphates. They've done well. We've held those positions for some time, but we recently added to them. And what we, going back a year or so, demand for grain around the world has been very, very strong for the last decade or so, driven mostly again by China. But growing conditions have been really strong too. And so you've had these periods of extreme productive crop yields and things of that nature. And so we've basically been in a balanced market, and grain prices have been sort of sideways and lackluster and what have you. And fertilizer prices have done nothing for the last several years. But every year you go into the growing season and you run the numbers and you say, this year you're going to have to see a bumper crop just to be able to make supply and demand meet. And what are the odds of that? Just looking at the distribution of yields and stuff like that, the odds are against you. And so prices ought to go higher. But year in and year out, we have gotten that bumper crop condition. And it does seem to be on a global coordinated basis that we've been very, very, very fortunate with crop yields. And so prices haven't really moved as a result of that. But every year we kind of reassess and we say, this is still, even though it's gone against us for the last X years, this is a pretty good risk return given what we need to see happen just to keep the markets balanced. And last year didn't. Last year we had some severe weather in a bunch of growing regions in the US, and that led to yields that were not as good as everyone expected. And so in a hurry, you went from a amply supplied year to a very, very tight year, and stockpiles drew as a result of that. Going forward, we have drought conditions in parts of the U.S. now going into the planting season, which bodes for a less productive year. So we are starting to see some indications coming out of China that perhaps something's happening with their grain conditions there as well. Again, you just have to read between the lines a little bit, but there are a lot of language and a lot of subtle points that sort of suggest to a shortage developing in the various grain markets, and that's leading to increased imports of Western grain, both wheat, corn, and soy. So I think what potentially we could have another sort of tight year here. We're going into it much tighter, and finally, both crop prices and fertilizer prices have started to respond. So we are quite bullish. Again, every year you've needed this perfect growing conditions just to have supply and demand meet. Last year you didn't. And I think this year we're shaping up to maybe have a tough year too. So all that bodes very well for price.
Well, Adam, thanks for coming on the show and sharing your insights. Your website is gorosen.com. And just as we conclude, what can investors find there?
Well, we're prolific publishers of everything that we do. We're trying to be very transparent. So we put all of our research in writing. We have some videos, some podcasts, all kinds of things like that. But we really try to be open and try to share with all of our followers what it is that we're doing. So if you have interest in the commodity markets, we definitely would invite you to come take a look. Everything's free. Nothing's behind a paywall or anything like that. And please come and take a look.
Excellent. Well, thank you for coming on the show today, Adam.
Thank you so much.